Gold and silver are taking a breath right now. Just a small pause. A moment of quiet before what could be a very loud week. And I know that when markets get quiet, when the daily moves shrink, when the headlines stop screaming, a lot of people tune out. They think nothing's happening. They go back to their normal lives and forget to pay attention. But that's exactly when you should be paying the most attention, because the quiet moments are when the market is coiling. They're when positioning is building. They're when the next big move is being prepared. And if you're not watching during the quiet, you'll be reacting during the chaos, and reacting is expensive. It's February 2026. Comment below what day and date you're watching this from. I always like to know when people are catching these videos, because market context changes fast. And while you're at it, drop your city and country in the comments. I want to see how far this community reaches. Are you watching from the US, Europe, Asia, Latin America, Africa, somewhere else entirely? Let me know. And if you're new here, this is Financial Crux. We break down markets, metals, and money without the fluff. If that sounds useful, hit subscribe and let's get into this. So here's what's happening right now. Gold is down about $10 in early US trading, sitting around $50.69. Silver is down about $50, trading around $81.75. These are not dramatic moves. These are not the kind of swings we saw last week when gold was dropping and rallying 4% in single sessions, and silver was moving 10% in a day. This is different. This is the market catching its breath. This is traders stepping back and waiting. And what are they waiting for? Two things primarily. First, the US jobs report on Wednesday. Employment data matters because it tells us how the economy is actually doing beneath all the noise. If jobs are strong, the Fed has less reason to cut rates. If jobs are weak, the Fed has more reason to ease. And rate expectations move the dollar, which moves precious metals. Everything is connected. Second, there's inflation data coming later this week, and inflation is the ghost that still haunts this market. We spent years dealing with inflation that was hotter than expected. Then it cooled, then it stopped cooling, and now we're in this uncertain zone where nobody quite knows if the battle is won or if we're going to see a resurgence. The data will provide clues, and clues move markets. So when you see gold and silver drifting slightly lower on a Tuesday morning, that's not weakness, that's anticipation. The market is positioning ahead of data that could change everything. Smart money isn't selling aggressively. They're not buying aggressively either. They're waiting, and there's wisdom in that. Now let me talk about something that happened in the past few days that I think is much more significant than most people realize. China just told its financial institutions to limit their purchases of US Treasury bonds. This is not a small thing. This is not a technical adjustment. This is a strategic shift that has implications for the dollar, for interest rates, and for precious metals. Let me give you the context. China has been one of the largest holders of US Treasury debt for decades. When the US government runs a deficit, when it needs to borrow money, it issues Treasury bonds. And for years, foreign buyers like China have been happy to snap those up. It was a way to invest their dollar reserves, earn some interest, and maintain their currency peg. But that relationship has been fraying. Trade tensions, tariff wars, geopolitical competition, concerns about dollar weaponization, all of it has made China increasingly uncomfortable with holding too many US assets, and now they're taking concrete action. Regulators are telling banks to rein in Treasury holdings, to trim positions where exposure is high, to diversify away from concentration risks. The yuan rallied on this news. It pushed to about 6.9 per dollar, near its highest level in almost 3 years. That's significant. The Chinese currency getting stronger against the dollar is a sign that capital flows are shifting. And it's not just China. There's a broader global move away from dollar assets happening beneath the surface. Central banks diversifying into gold, sovereign wealth funds reducing treasury exposure, alternative payment systems being developed to bypass dollar hegemony. This is what I mean when I say you have to pay attention during the quiet moments. On the surface, gold is down $10 and nothing seems to be happening. Underneath, the tectonic plates of the global financial system are shifting, and those shifts are what will ultimately drive precious metals prices over the coming years. Now here's something interesting that President Jinping said recently. He outlined ambitions for a, quote, powerful currency. That's not random rhetoric, that's a statement of intent. China wants the yuan to be a major reserve currency. They want to reduce their dependence on the dollar, and every step in that direction is a step that supports gold and undermines the dollar's monopoly position. Quick pause. I want to hear from you. Do you think China's move away from treasuries is a short-term political play, or do you think it's the beginning of a fundamental shift in the global financial system? Drop your answer in the comments. I'm curious what this community thinks about the bigger picture. Now let's talk about something that's making waves in the political and economic sphere. President Trump said that his pick for Fed Chair Kevin Warsh can produce 15% GDP growth in the United States. 15%. Let me put that in perspective for you. The U.S. economy has grown at an average annual rate of about 2.8% over the past 5 decades. That's the long-term trend. In good years, you might get 3.5 or 4%. In great years, maybe a bit more, but 15%, that's not an economic projection. That's fantasy land. Now, I'm not here to make political statements. I'm here to analyze what this means for markets, and what it means is pressure. Kevin Wersch, if confirmed, is going to face enormous pressure to deliver results that are essentially impossible to deliver through monetary policy alone. The Fed doesn't control GDP growth in that way. The Fed controls interest rates and liquidity. Those tools can support growth at the margin, but they can't turn a 2% economy into a 15% economy. So what happens when you set unrealistic expectations and then reality fails to meet them? You get frustration, you get blame, you get policy volatility, and all of that is uncertainty. And uncertainty tends to be supportive for safe haven assets like gold. Here's the other piece of this. Trump called Powell a, quote, big mistake. That kind of rhetoric undermines confidence in the independence of the Federal Reserve. Markets like to believe that the Fed operates free from political interference, making decisions based on economic data rather than political pressure. When that belief is challenged, when it looks like the Fed might be pushed in politically convenient directions, the credibility of monetary policy comes into question. And what happens when people lose confidence in the institution that manages the currency? They look for alternatives. They look for stores of value that don't depend on political decision-making. They look for gold. They look for silver. They look for things that have held their value for thousands of years, regardless of who was in charge. So, while Trump's 15% comment might seem like just another headline, it actually tells you something about the environment we're operating in. An environment where monetary policy is under political pressure, where expectations are detached from reality, where uncertainty is elevated, and where precious metals have a role to play as a hedge against that uncertainty. Let me shift gears and talk about something that's directly affecting investor behavior right now. The volatility of the past couple weeks has left marks, real marks, not just on portfolios, but on confidence. Commerce Bank put out a note highlighting just how extreme the swings have been. Gold rose almost 4% on Friday after falling a similar amount the day before. Silver was even wilder, up 10% on Friday after sharp declines earlier in the week. At one point Monday, gold was trading above $5,000, around $400 higher than Friday's low. Silver was above $80, almost $20 higher than Friday's low. These are not normal moves. These are the kind of moves that make people question whether they understand what they're invested in. And here's the consequence. Gold ETFs tracked by Bloomberg recorded outflows of about 20 tons last week. That was the first weekly outflow in 5 weeks and the strongest weekly outflow since the end of October. That's significant. When money leaves ETFs, it's usually a sign that investors are spooked. They're taking profits. They're reducing exposure. They're stepping back. Now, silver ETFs showed a more complex picture. On net, there was an inflow of about 700 tons for the week. Sounds bullish, right? But here's the nuance. Almost all of that came from a massive inflow of nearly 1,000 tons at the beginning of the week. After that, after the volatility hit, there were outflows from silver ETFs too. The buying came before the crash. The selling came after. That's the pattern of investors getting caught on the wrong side of a move. And there's one more detail that really struck me. A silver fund listed in China had to suspend trading for an hour on Friday. When it reopened, the price fell by the maximum possible amount, which was 10%. When a fund has to halt trading and then immediately tanks the daily limit, that's chaos. That's the kind of thing that shakes confidence. That's the kind of thing that makes people say, I'm out of this madness. So when I tell you that the current pause in gold and silver is partly about recovering from the trauma of last week, that's not an exaggeration. The market is licking its wounds. It's reassessing. It's trying to figure out if the volatility is over or if there's more to come. And here's my honest take. The volatility probably isn't over. We're heading into a jobs report. We're heading into inflation data. We've got geopolitical tensions still simmering. We've got China making strategic moves against the dollar. We've got political pressure on the Fed. Any one of these could be a catalyst for the next big swing. And when you stack them all together, you get an environment where large moves are not just possible, they're probable. Let me ask you something. Did the volatility of the past few weeks shake you? Did it make you reduce your position, or did you hold steady? Drop your answer in the comments. I want to understand how this community experienced the chaos. Now let's talk about something positive, because not everything is doom and volatility. America's gold and silver, which trades under the ticker USA, just climbed 12% on Monday. 12% in a single day. And it happened because TD Securities issued a buy recommendation with a price target that represents about 20% upside from current levels. What's driving the optimism? Operational improvements at their Galena complex in Idaho and genuinely impressive production numbers. Consolidated silver production jumped 52% in 2025 compared to 2024. They went from 1.74 million ounces to 2.65 million ounces. That's not a marginal improvement, that's a step change in production. Their Casala site alone hit annual production of 1.19 million ounces, with a record quarter of 463,000 ounces in Q4. When you see a miner ramping up production that dramatically while silver prices are elevated, the math on earnings becomes very attractive. Now, I want to be clear, I'm not telling you to buy this stock. I don't give stock recommendations. I'm showing you what's happening in the mining space because it illustrates a broader point. When the underlying metal price is high, when production is growing, when costs are under control, miners can deliver exceptional returns. The leverage works in your favor. But the reverse is also true. When metal prices drop, when production disappoints, when costs overrun, miners can get crushed. They're leveraged plays and leverage cuts both ways. So if you're going to invest in individual mining stocks, you need to do your homework. You need to understand the specific company, its assets, its management, its balance sheet, its jurisdiction risks. The reason I highlight this particular example is because it shows that even in a volatile, choppy market for silver, there are opportunities. There are companies executing well and getting rewarded for it. The key is being able to identify them and having the conviction to hold when the broader market is in chaos. Let me zoom out and talk about the geopolitical backdrop because that's providing ongoing support for safe haven demand even when prices are drifting. Russia and Ukraine are still at war. Peace talks are happening, but according to Estonian intelligence, Russia is just buying time. They're exploiting negotiations as a tool for manipulation with no real intention of ending the invasion. The assessment suggests Russia's main objective is restoring full relations with the U.S., which would open possibilities for direct flights, visas for the business elite, and easier paths for espionage and influence operations. Meanwhile, Russia is likely preparing for future conflicts even as the current war continues. Their military-industrial complex will remain a danger to neighbors even after any peace deal. This is the world we live in. Negotiations that might be theater, powers preparing for future conflicts while current ones still rage, espionage and influence operations being planned under the guise of diplomacy. None of this is particularly comforting, and none of it suggests that the factors driving safe haven demand are going away anytime soon. The reason gold and silver haven't collapsed despite the volatility, despite the ETF outflows, despite the confident shocks, is because the underlying uncertainty remains. People don't buy gold because they think the world is getting safer. They buy gold because they're not sure what's coming next. And as long as that uncertainty persists, there's a bid under precious metals. Now let's look at the key outside markets. Because gold and silver don't trade in isolation. The dollar is slightly higher today, which is creating some headwind for metals. When the dollar rises, commodities priced in dollars tend to face pressure. That's a mechanical relationship. It's not complicated, but it's important to track. Crude oil is trading around $64.50 a barrel, slightly up. Oil prices matter for the broader inflation picture and for general risk sentiment. Stabilizing oil isn't creating the kind of economic pressure that would force aggressive Fed easing, but it's also not spiking in ways that would reignite inflation fears. The yield on the 10-year Treasury is at 4.1%. That's a key benchmark for borrowing costs across the economy. It's also a key input for valuing gold because gold doesn't pay interest. When bonds offer higher yields, there's an opportunity cost to holding gold. When yields fall, that opportunity cost shrinks and gold becomes more attractive. These relationships aren't deterministic. Gold can rise even when the dollar is strong or yields are high if there are other factors at play. But understanding the headwinds and tailwinds helps you interpret price action. When gold is flat on a day when the dollar is up and yields are stable, that's actually relatively strong performance. It tells you there's underlying demand absorbing the headwinds. Let me give you a framework for thinking about the next few days because we're heading into event risk. The jobs report on Wednesday is the first major hurdle. If the number comes in strong, if employment is holding up better than expected, the immediate reaction will probably be dollar up and gold down. Traders will price in a Fed that can stay patient on rate cuts. That's the short-term dynamic. But here's the nuance. Strong jobs with rising wages could also feed into inflation concerns. And if the inflation data later in the week confirms that prices are sticky, you get a more complex picture. Yes, the economy is strong, but if inflation is persistent, the Fed is in a difficult spot. And difficult situations for central banks tend to create uncertainty, and uncertainty tends to support gold over time. Conversely, if the jobs report comes in weak, the immediate reaction could be dollar down and gold up. Traders would price in faster rate cuts, Looser policy, easier financial conditions, that's straightforward. But again, there's nuance. A weak jobs report could also signal broader economic weakness. If the economy is slowing sharply, risk assets could sell off. And in a risk-off environment, even gold can face selling pressure temporarily as traders raise cash and cover margin calls. We saw exactly that in the chaos of the past couple weeks. So here's my approach. I don't try to predict the data. I don't know what the jobs number will be. Nobody does with certainty. What I do is prepare for multiple scenarios. If we get a bullish reaction in gold after the data, I know my levels for adding. If we get a bearish reaction, I know my levels for either trimming or just holding steady if support holds. The key is having a plan before the data hits, so you're not making decisions in the heat of the moment. Let me talk about levels because that's where the rubber meets the road. For gold, the immediate resistance is around 5,100. That's where rallies have stalled recently. If we can clear that level with conviction after the jobs data, the next targets are 5,300, and then the January highs around 5,450. Above that, the all-time high at 5,598 comes back into play. On the support side, we're currently around 5,069. Below that, 50,000 is a psychological level that could attract buying interest. And below that, the key support from recent price action is in the 4,900 to 4,950 zone. If we break below that on a closing basis, you'd have to start questioning whether the correction has more to run. For silver, we're at 8,175 right now. Resistance is in the 84 to 85 zone, where recent rallies have struggled. Support is around 79, where dip buyers have stepped in. And if we break 79, 75 becomes the next line of defense before the February lows around 64. The one thing I'd add is that given the extreme volatility we've seen, intraday moves can be deceptive. A move that looks like a breakout at noon can be completely reversed by the close. That's why I focus more on closing prices than intraday spikes. Where does the market settle at the end of the session? That tells you who won the day. Here's a psychological observation based on watching markets for a long time. The current environment is designed to make people make mistakes. The volatility shakes confidence. The headlines flip from bullish to bearish and back. The ETF flows suggest retail is scared. And into all of that, we're about to get economic data that could move markets dramatically. The temptation is to do something, to trade, to adjust, to try to get ahead of the move, but sometimes the right thing to do is nothing, especially if you're a longer-term investor with a thesis you believe in. The data will come, the market will react, but the fundamental story, the supply constraints, the central bank accumulation, the currency debasement, the geopolitical hedging, none of that is going to change because of one jobs report. Now, if you're a trader, you probably do want to be active around these events. That's the game you're playing. But even traders need discipline. They need stop losses. They need to know in advance what would tell them they're wrong, because trading around data releases without a plan is just gambling with extra steps. Let me ask you this. Are you planning to trade around the jobs report, or are you just going to watch and let the dust settle? Drop your answer in the comments. I want to see how people are approaching this. Now let me address something that comes up often in the comments. People ask, why don't you just tell us what to do? And I understand the frustration. It would be easier if I just said, buy here, sell there, this is going to 100, we're going to 0. But that would be dishonest because I don't know what's going to happen, and anyone who claims they do is either lying or delusional. What I can do is lay out the analysis, show you the factors that matter, explain the levels, share the frameworks I use for making decisions, and then you take that information and apply it to your situation because your situation is different from mine. Your risk tolerance is different, your time horizon is different, your life circumstances are different. The right trade for me might be completely wrong for you. That's why I focus on education and analysis rather than prediction and tips. I want to make you a better investor or trader over time, not just someone who follows calls. Because if you can only make money when someone tells you what to do, you're not really in control. You're just hoping that person keeps being right. And hope, as we've discussed, is not a strategy. The goal is to get to a place where you look at a chart, you understand the context, you know the levels, you have a plan, and you can execute that plan with discipline regardless of what everyone else is saying. That's the skill set that creates long-term success. And that's what I'm trying to help you build. All right, we're getting toward the end here, so let me bring this together. Gold and silver are pausing ahead of major data releases. The jobs report on Wednesday and inflation data later in the week will likely be catalysts for the next significant move. The market is catching its breath after extreme volatility that shook investor confidence and triggered the biggest ETF outflows in months. Underneath the surface, bigger forces are at work. China is actively steering its institutions away from U.S. Treasury exposure. That's part of a broader global diversification away from dollar assets that's structurally supportive for gold. Trump's unrealistic growth expectations for his Fed pick signal an environment where political pressure on monetary policy is elevated and geopolitical tensions continue to simmer, providing ongoing safe haven demand. Individual miners like America's gold and silver are showing what's possible when production grows and operations improve in a favorable metal price environment. But investing in miners requires homework and comes with risks that physical metal doesn't have. The key right now is to not let the quiet fool you. The pause is temporary, the volatility is not over, and the setup for the next leg, whether it's up or down, is being built right now while most people are distracted by the lack of action. Here's my question for you, and I want to see this in the comments. Given everything we've discussed, the data releases, China's moves, the ETF flows, the volatility, what's your game plan for the rest of the week? Are you adding, holding, trimming, or sitting in cash and waiting? Drop your answer below. Let's build a conversation. Before I let you go, a couple of things. If you want real-time updates and analysis that doesn't always make it into videos, join our WhatsApp community. The link is in the description. It's free, and it's where we discuss what's happening as it happens. Also, follow us on X at Financial Crux. That's where I post quick takes on market moves throughout the day. And if you know someone who's confused by the volatility, who's wondering whether they should panic or hold steady, send them this video. Context helps. Understanding helps. And sometimes knowing that others are navigating the same uncertainty makes it easier to stay the course. The market is quiet today, but the quiet won't last. Data is coming. Volatility is coming. And how you position yourself now will determine whether you're ready to capitalize on the next move or whether you're just another person reacting after the fact. Stay sharp, stay patient, and I'll see you in the next one. This is educational content, not financial advice. I'm not your advisor. I don't know your situation or your risk tolerance. I could be wrong about everything here.